Another prominent market-wise, Chakri Lokapriya is here with us in the studio. Chakri, good morning to you.
Good morning.
Extremely fragile setup from a global standpoint. Our markets, though, seem to be fairly okay at this point, considering that we've already seen a huge sell-off from our highs. But earnings season was supposed to be a silver lining. People entered the earnings season having higher anticipations from companies, but that's not really working out too well.
Indeed, the earnings season has actually, while it's slightly better than expected, I think there are a slew of things that's going to happen as we go into this next couple of quarters. One is slowing demand, higher cost of funding, higher input costs. This is for companies across sectors. So against that backdrop, you are likely to see lower than expected sales and earnings, and that is clearly a worry for the market, at least in the near term.
So the cost increases is something that we're already seeing in this quarter's earnings. So do you see that getting exaggerated a little bit more? And liquidity, higher interest rates, obviously with a lag of transmission lag, will be seen in the latter half of the year, according to you?
Indeed. Let's take NBFCs or banks. They have a higher cost of funding. So tomorrow, if I need to go and buy a washing machine and I want to take an EMI, I'm going to pay a higher EMI for that. So there is, and that is going to hold me back from buying or delay my purchases. So you have that kind of a knock-on impact across various sectors. And then on top of that, the washing machine company itself is facing input cost pressures in terms of the metals and raw materials that go into making of that. And then the bank in itself, which is lending, or NBFC, which is lending to these companies, they can't pass on the entire amount because there is competition out there and they want to maintain some kind of a thing. So they're also going to make lower margins. So against this backdrop, you have generally an environment of lower profits, lower margins, and therefore lower multiples for the market.
Interesting. Some of the names and stable names which are now declaring some exposures to accounts which could be suspect. L&T Finance Holdings is a case in point, Chakri. What do you do with such names?
First off, wishing you a really great happy birthday.
Thank you so much.
And only wish it was a nice green day. But maybe next year it's going to be a rocking year.
Well, hope so.
From here on.
Well, thanks, yeah.
And L&T is their disclosures of exposures to, L&T Finance we're talking about, exposures to IL&FS and also the real estate company has, while on one hand it's good that they were transparent and all that good stuff, on the other hand it does create a liquidity issue or a cost of borrowing issue for L&T Finance. And because IL&FS is not going away anytime soon, and it again defaulted, I guess, a couple of days ago on a payment. And this trend will continue. I guess ample liquidity is need of the hour, not just for L&T Finance, but for the whole NBFC, banking, the whole sector. And this is not like a one-off thing which RBI is trying to do, but rather needs to be a sustained thing over the next several months. And that is the need of the hour.
So, the question, Chakri, is that some people will say that damage is in the price. Let's assume that the damage is in the price for some of these names. But if liquidity is not going to come back, they're not going to be as competitive as they used to be. And therefore, there might be a protracted time correction as well. You may well buy it at whatever levels it may. I'm not saying it's overvalued or undervalued, but I'm just saying a stock X, which has fallen because it's got multiple issues, including exposure to IL&FS, and has fallen off, it may well stay at those levels for a really long period of time. Are people better off just shunning these names and going on to either the safer names in the NBFC space or actually looking at spaces which are non-NBFC?
Indeed, I think that's a very good question, and you're absolutely right. I think lower margins will be there for quite some time to come for the NBFCs. And within NBFCs, those guys who have a greater asset liability mismatch will have a longer time to recover. And meanwhile, the stronger NBFCs will take market share away from the weaker NBFCs. And banks will take away market share from the NBFCs in general. So as this whole thing unfolds, because NBFCs took market share away from the banks, and so now it's payback time in the reverse thing. And banks are slowing down their lending to NBFCs. Mutual funds are slowing down their lending to NBFCs. So overall loan growth rates, which used to be 30, 40%, 25% for NBFCs, which was one of the reasons you gave them high multiples. And now instead of a 25-35% growth, if you're going to grow, let's say 20% growth, still a fantastic number, but the valuations don't justify that. And so valuation multiples will come down quite dramatically from 4-5 times to maybe 1-2 times.
So you think there's still more course correction left? And the other point being, now real estate, it is sticking with NBFCs, real estate exposure is starting to look extremely dicey on their books. So is that the next level of pain that we could see unraveling?
And real estate has a huge amount of unsold inventory across the country, various of varying sizes. So they have financing costs, rolling their financing costs is a very important component, which has stalled in the last few weeks. And that is likely to continue, and so their cost of funding is going to go up. So it's not actually such a doomsday scenario. It is bad in the sense that, yes, they can still liquidate their inventory at a lower margin. So I think that is the next shoe to drop for the real estate sector. You will have an environment where the 20% margin that they were making on the final product will probably come down to 5%, because if you have to sell, you have to sell. And so once that cycle for that cycle to happen, I think that will be a part of the preconditions that NBFCs, banks, etc., will put on the real estate sector in the coming months, because now you have to push to clear out.
The other pocket now, obviously, that everyone had been considering as the safer haven investments, and we might sound repetitive because we talk about IT so much, but that's probably something that everybody anticipated would give the next leg up because of the rupee tailwind. But the earnings so far, even with the meat, has been disappointing the street, at least on the pricing front. The trajectory going forward is something, the guidance that the management giving is something that's being a little bit more disappointing.
See, IT as the underlying demand for the whole sector, whether it's large cap or mid cap, is still very strong. Now the year-over-year growth rates have been fairly decent. If you look at sequential growth rates, that's been kind of missing the numbers, because we in IT companies did not anticipate the pace of the rupee fall versus the dollar. And all these guys have a huge amount of, the larger the company, the more cross-currency hedges.
Yeah.
So they don't really benefit that much just because the rupee falls 15%, they gain 15%. That hasn't happened that way, and unlikely to happen that way. And some portion of the margin thing benefits their, plowing it back into the system. Underlying demand is because US today, when they're reporting earnings, S&P 500 is still reporting a 20% earnings growth. So US companies are still very strong. Europe is good. The end markets for IT. So I think as a sector, they will still continue to outperform the Nifty as well as the broader market.
Maybe now some leeway to perform as well, because the stocks have come off so much. Chakri, what did you make of the QSR names? Same-store sales growth for Jubilant seemed okay. The numbers seem marginally ahead of estimates. At least some of the brokerages who track Jubilant very closely mentioned that. The stock is reacting very, very negatively, though. Is it again a case of our valuations getting pared down, or is it something else?
Valuations are likely to come down because this sector is facing competition which it never faced many years ago.
You mean the
the QSR. So you take a Jubilant for that matter. They were the only guys making pizza 10 years ago. Now every street corner is making restaurant is making a pizza. So that's competition.
And delivering pizza.
And delivering pizzas, and that will bring down margin. Now what Jubilant has still going for it is phenomenal delivery, rolling out branch expansion, same-store sales is still fairly good, but the profit margins is coming down because of competition, because of attrition. People poach away their staff. The other restaurants poach away their staff. So there is a higher attrition, higher training costs, which translates higher staff costs. All these things translate to lower margins. So against this backdrop, the multiple that you used to give 5 years ago, 10 years ago, needs to be lower today than you did.
Okay. One final question, Chakri, at least from my end. Would you be a buyer in the top quality retail focused banks right now, the HDFCs, Kotaks of the world, or would you rather prefer, say, maybe an ICICI or an Axis, corporate facing banks, lower valuations?
I would be a buyer of both corporate and retail facing bank, the leaders. But the leaders also are going to face lower multiples than they did in the past.
Yeah.
And for two or three very simple reasons. One of the things that you talked about PSUs, that PSUs, chairmen, CMDs used to be replaced faster. And now you have, including ICICI and Axis, where they're saying the CMD's tenure is limited to 3 years versus the 5 years asked for, which is not such a great thing. So against this backdrop, I think there will be a general derating of all banks, but I'll be a buyer of retail and corporate banks both.
Great. Okay, Chakri, we'll leave it at that. Thank you so much for taking the time out and joining us today and giving us your perspective.
Thank you.